Ladies and gentlemen, it's Modern Investing on Pod TV. My name is Sasha Star, and today's guests are Dr. Milan Sambarak. Welcome to the show.
Delighted to be here. Thank you for
Okay,
inviting
Jim
me.
Eat from Eat Foundation. Welcome to the show, Jim.
Thank you for inviting me, Sasha.
And our beautiful Irene Parker. Welcome to the show, Irene.
Thank you.
So yesterday was a very interesting day. It was a slide of everything was in red and there was no place to hide. And now it's Wednesday. So Wednesday, as usual, the market is up. It's very nice recovery. And everything is green, or at least most of it is in green. And so was yesterday a day for brave people who would buy on a dip or not? I did yesterday one transaction only. I bought 5,000 units of max yield CONY, CONY, which is ETF of covered call strategy on Coinbase. Stock is very nicely today. Now the question is a very practical question. I can close now my position and realize $3,500 profit, or I can keep it because they reported already a dividend of $1.10. So therefore I can get on my account on Monday $5,500. Of course, the shares itself, they will go down tomorrow. How much down? That remains to be seen. So I decided, well, I'll keep it because of my greediness. If I can get today $3,500 and in 2 days, or 3 days actually, $5,500. So to me, the extra $2,000 in 3 days, I'll go for it. But
A question, doesn't the stock drop by the amount of the dividend?
not necessarily. It could drop even more than amount of dividends, but it could drop less. It's very important what Coinbase stock itself will do. That's very important. Now, you see,
There's a difference between value and price. The price might drop or rise, but the value absolutely drops by the amount of the dividend. So much money has left the company to pay the dividend, so the value drops. The price might not. The price could go either up or down.
Okay, I agree with that, and that's exactly what's happened. I have another similar position, but much larger than this one, in NVDY, and they reported a nice dividend, and stock went down somewhat, but less than the dividends what they pay. Mind you, they went down yesterday as everything else went down, but it's recovering already today quite nicely. Let's continue to talk about it. Maybe Shaquille, if he's there, maybe he will tell us more about it. Hi, Shaquille.
Great morning.
Great shirt.
I missed. I had to have something a bit brighter than you. You've beaten me the last couple of times, Jim. So I missed a little bit of what you said there, but I did catch the thing about dividends. It's an interesting play. A lot of people will actually play sort of dividend harvesting strategies, and it generally works better if you actually are a citizen of the country or a taxpayer of the country. So Australia, for example, we have imputation credits which attach to the dividends. So some of those benefits are lost to international investors, but Australian local investors, it can work quite well. And if the stock stays at that price or doesn't fall by as much as the dividend, then that's actually a really nice little strategy. But I tend to find that if it's a strong company that pays a dividend, the stock tends to recover, but there's no hard and fast rules on this. So,
well, in Canada, they, for example, I have this account where I'm trading this in US. And in US, they withhold tax. So let's say I should have got $11,000 from NVDY, but I actually got slightly less than 10. So the rest was withheld as a tax. Same thing will happen with CONY on Monday. I will know better what I will get exactly, but I'm planning to get 5,500. But I would allocate probably 600-700 as tax. But that's okay. See, mind you, the strategy here is the income strategy. It's not a stock play strategy. So the valuation, the fluctuation of stock itself, whether it's Kony or NVDY, is insignificant, because if you keep it from month to month and month, and you keep collecting dividends, the stock will be paid in less than a year time, and you still collect dividends. So I think that's a strategy. Now, I think I said last time that I'm planning actually to have, there are 4 groups. They're paying dividends each every 4 months. So if you have in Group A 1 stock, and in Group B, which is NVDY, and Group C, which is Kony, and Group D, which I don't have, nothing, but I'm planning to acquire MicroStrategy, which is probably the riskiest of them all, but I'm playing with the idea. But I will not do it until I will be paid dividends on Kony. So then I need something to add in Group A, probably Tesla. So in this case, you can collect several $1,000s each and every week. So then I thought, why do I need any other stocks? Maybe I should sell everything, invest in this strategy in each one each week, and just live on dividends, and that's it.
What's the difference in the yield between the groups?
You see, you don't know the yield until they will announce, and every 4 weeks it's a different announcement. It depends how successful was their strategy of selling covered calls, and it varies. I think on NVDY there were a few weeks when they were paying $2,500. Last time they paid only $1.15, I believe. And
what was the historical yield though on those 4 groups?
It varies. Sometimes it was a couple of times less than 1,000. A couple of times it was 2,500. Now it's
the yield.
Yeah,
not the dollar amount.
Yeah, but it's very difficult to calculate, because each time they declare different dividends. So, okay, if you will take last 12 months, if you will add up and divide it by 12, but now they're paying every 4 weeks instead of a month. Well, you can arrive, but I'd say on average, you'll be surprised. It's going to be 70 to 80%.
There's no panacea of just trying to buy dividend-paying stocks in order to just enhance yield, because there's other risk factors, and I think you've got to be careful about concentration risk. But I do like some of those monthly dividend-paying stocks, especially the ETFs that pay a monthly dividend. And I think that as you guys know, I don't like covered calls as a strategy in general. It works for other people. I think that's a very basic strategy when people are starting out.
Sure.
But in that particular case, covered calls or naked puts, which are synthetic equivalents of each other, are an interesting way of actually enhancing an already high-yielding position. And things like the emerging markets debt ETF that I talked about last show, that could be a very interesting kind of play for those sorts of things. But the other thing that I would say to people is, if you're looking for income, you have a lot more control, in my personal opinion, if you just do income-based options positions. You do a butterfly, do a condor, and you don't have to reinvent the wheel. Do a condor over the S&P 500. It's not going to move that much generally. Do a butterfly, something like that. If you want a little bit more risk, do a broken wing butterfly. Those sorts of strategies, they're fairly easy to put on. Few legs, so you've got to, because of the brokerage, you need to have a position of some size in order to justify the brokerage. But those sorts of things you can do, and even just something as simple as a bull call spread or a bear call spread or something like that, or a synthetic equivalent with puts, is a way of bringing some income in.
I doubt that you, with the strategies that you just described, that you will achieve 70 to 80% annual profit.
Well, you should be able to. I mean, a general butterfly or condor strategy over the S&P 500. If you don't lose, if you were to keep winning, I think you would probably be looking at those sorts of returns. I mean, look, having said that, I would never dream of putting those strategies on, but I'm just saying, if you're starting out, that could be a good place to start.
Shakil, they're charging only less than 1% in management. So let's see, very liquid
I'm going to be
position.
right back. My battery's dying. I was going to plug my phone in. Sorry.
Okay, on a very liquid position as NVDY, they have 700 million shares out. So if they collect 1% of it, you're talking about $7 million a month. So they have huge incentives, and probably they have automatic trading anyway. But even it doesn't matter how they do it, to me, in my opinion, because they produce results. That's way much more important than anything. So I don't mind to pay 1%.
Let me save you a lot of talking here.
Sure.
You know of the dividend aristocrats. Dividend aristocrats are companies which have been paying an increasing dividend every year for more than 20 years.
I heard about it about 50 years ago, and it's still valid today.
Okay, all right. So dividend aristocrats. Now, if you invest, there are investment opportunities that are nothing but dividend aristocrats. If you invest in those, you would not have done as well as if you bought the American market as a whole, as shown by an exchange-traded fund which tracks the S&P 500.
On the other hand,
SPY happens to be the best.
Sure.
The largest, the oldest, the smallest bid-ask spread, and so on. So if you bought nothing but the American economy as a whole, you would have beaten the dividend aristocrats. So why bother?
Because you're trying to generate an income strategy. If you're buying the S&P 500 on a fund, then what are you just liquidating portions of it to generate your income?
That's what he does. Yeah.
And is no one here a bond fan?
Yeah, I trade bonds, but probably not in the way that you'd want to hear about, Irene. So I trade the high risk, and I highly lever into my positions. Milan, let me just say, I think that you're comparing apples to oranges in that analysis there. So if you buy the index and hold it, and you buy dividend paying stocks, what outperforms each other? Well, the problem with that calculation is, to make that calculation fair and comparative, you would have to reinvest the dividends that come out back into the market and then compound that over 20 years. So if you were to do that, that would then bring those returns back in line. So I think that would be a fairer comparison. And I think that's the issue, as Irene pointed out, it depends on what people are looking for. I will also just say that if you are looking for dividends, this is one of the rare times I will say to investors that they should look outside of the United States. The US is a bit funny when it comes to dividends, because the attitude in the United States with a lot of companies is, if we pay a dividend, it shows a sign of weakness from the company, because we're telling our shareholders that we think that you are better with this money than we are, that we as a company don't have any plan for the money, so we're going to pay it out. But that's not the attitude in Australia, for example. So Australian
you have
stocks
to
tend to
consider
pay
the
a much
industry.
higher.
You have to consider the industry, though. A lot of people will buy utility stocks because of their high dividends. So you really can't compare that.
There are exceptions to the rule, obviously, but as a general rule, you will see that Australian companies and to some degree British companies are actually generally paying dividends a lot more and at a higher yield than what their US counterparts will be. But again, horses for courses, it depends on what you are specifically looking for and what's going to suit your particular portfolio the best. But if dividends and income is what you're looking for, there are other opportunities to provide that.
Berkshire Hathaway has been the best performing stock. Nothing comes close to it. It has never paid a dividend.
Except high yielding ETFs.
but Berkshire Hathaway, when Berkshire Hathaway's, where it's one share price, well, one share is going to cost you $250,000, that became inaccessible. And the other thing that Warren Buffett refused to ever do was to split the stock. So then people, in order to get access to it, have to buy ETFs, or they have to buy Series B and C shares. So is that a good strategy? It's a wonderful strategy if you bought the shares, 3,000 years ago, before Jesus was born, right, and managed to ride the Berkshire Hathaway wave. But many of us aren't living as long as that.
Even shortly after his death, if you would buy it, you would do it as well.
I had nothing but Berkshire Hathaway for more than 30 years. And so it's done wonderfully well without ever paying a dividend. And so now you're talking about Australian markets and other markets. Nothing comes close to equaling the U.S. market for over 100 years. Why would you look at Japan, which still hasn't recovered? After 40 years, it's at half of what it was 40 years ago. Why would you look at Australia?
Because of things like Jimmy Carter. The market just was in a decline for about 10 or 15 years. And I know with the American funds, the Capital World Growth and Income has been extraordinary. So I think there are times when, just for diversification, not to just put all your eggs in one country.
Well, there are times, Irene, but we shouldn't try to time markets. We shouldn't pick stocks. Don't pick stocks.
Milan, again,
Don't
I
blame
think
Jimmy Carter. Come on, he was only there 4 years.
Yeah, but the but the interest rates stayed high for a long. I knew those brokers.
Those
They were the most conservative brokers you'd ever know.
Those interest rates started under Gerald Ford. Those raises, and it was OPEC. It was the oil embargoes. You know, there's so much about why the interest rates were so high.
But the point being, there are periods of time when it's good to not just be diversified, just concentrated in one country.
I would like to add.
Milan, I think to answer. Sorry.
I would like to add something about the dividends discussion what we just had. In my opinion, the foundation of the company, if you take any public company, okay, so you have its assets, its book value, then you take their bonds that they issued, other debts what they issued, and on top of it, there is stock, common stock of the company. So when you're buying a stock, you're buying something what's on top of the pyramid where underlying things, so many things could go wrong. I'm not talking about Enron or anything like this, but still, there is a huge risk, and you are on the top of the pyramid, which will crumble. The first to go, it will be common stock. So in my opinion, at least that's what I'm following for myself, is you must be paid for holding any stock, either through options, covered calls maybe, or dividends. If you don't get neither of these two, you should not hold common stock at all.
Well, how do you feel about preferred stocks?
It's a different animal because preferred stock is ahead of the common stock, of course. So then you have a layer of protection. But if the company doing well and its stock price, like common, will go higher, it will do better than preferred in most cases. So anyway, there was very funny thing in Canada. It was around the end of 80s. There was one stock. Maybe you remember. I think it was it was warrants on a BTB price. And this warrants, there was very funny things that they were trading and had good volume and so on. But there was a stipulation that owners, and it was trading at say $5-6 a share. But there was stipulations that the holders of these warrants must buy stock at $1. So who would care at $1? Okay. A BTB collapsed when it was crashed in 87. So a BTB price collapsed, and these warrants, they went, believe it or not, to minus $2. Mm-hmm. They went to minus because there were obligations. People who bought the warrants at $5-6, now they had obligation. Furthermore, they lost all their money. They still had an obligation to buy it for $1. So it was minus $2. That's the people still. Okay, stock cannot go lower than $0. Well, I have that one example when it went below $0.
Everything you're saying so far, it goes in line with what we state is don't pick stocks. Don't time markets.
Oh, I never said though, so it's not in line with
Can I just respond to something that you've said there, Milan? So you make the point, well, why would anybody look outside the United States in the first place? Well, look, in raw numbers at the moment, the US is expected to have more growth as a headline, like raw figure, than any other country. The estimates at the moment coming out of the Treasury Department would suggest that the US economy will grow to something like 50 trillion, to something like 50 trillion in annualized GDP over the next 10 or 15 years. Now, that sounds like massively high number, but I don't doubt it. I mean, the way with inflation being where it has been and things like that, yeah, it probably will hit that, if not higher. And the US needs it to as well, so that they can pay off some of that debt that they've got. But that's a whole different story. Well, why would you look at other places? Well, let's have a look at China, just as an example. China's been hit pretty hard over the last 12 months or so, but this last quarter, the Chinese market has rebounded somewhat. If you have a look at Europe's been.
Hold it. The Economist itself, that's a very respected publication, said you cannot trust Chinese numbers. Yeah.
But the Chinese stock market has gone up. That's that. If you had taken an ETF over the Chinese market, it's gone up in the last quarter. If you have a look at Europe's a very interesting situation at the moment, because they've got weak numbers when it comes to consumer spending and manufacturing, but they actually have a bump in their job market. So it's an interesting scenario. You've got the US, which has got some increasing strength, some increasing consumer spending, a progressively stronger jobs market. Non-farm payroll numbers were a little bit mixed, but the rest of it was up. And you're seeing some Fed easing, which is going to provide a boost to the market. The point being that you can look at different sectors off the market within the United States. As I said the other day, you might look at the energy sector versus, I don't know, the automotive sector, or however you want to slice and dice the markets up. It's also important to have a look at a macro level when you think that another country might perform better than another. So if you come to the conclusion that the UK market is going to outperform the US over the next 3 months, that's not really that you're betting against the US. You might think that they'll both go up. It's just that you think the UK will go up by more or less. So again, if you're more active in the markets, then these are some of the things that you'll look at. If you're less active in the markets, then yeah, just go and buy an index and just hold it. I would still say, though, that if you are going to just go and buy an index and hold it, go buy the NASDAQ. Why would you buy the S&P 500? Because the NASDAQ has more volatility, but if you're going to hold it over a long period of time, that volatility will go away and you'll end up with a much higher return. The next thing I'll just very quickly touch on is that when the US has a massive economic event, you have to look at how it affects other countries. So Canada, for example, if you look 10 or 15 years ago, the Canadian dollar had decreased quite dramatically. There was a lot of economic turmoil. What did that create? It meant that Canada looked cheap to Americans, and so Americans went in and bought assets. If you look at what happened after September 11, the Aussie dollar against the US fell to below 40 cents. So US investors would rush into Australia to buy up assets. And then eventually the Australian dollar went $1.20 against the US, which was way too high. So you'd start to rotate out of Australia back to the US. These, I think, are good strategies for people to look at, because you're not picking individual stocks, you're picking whole economies.
Here's something interesting. You cannot invest unless you save. Save is the number one step before you can invest.
It's too late for me.
Savers today are losing money because interest rates are dropping. People who are saving are losing money. Yet you have to save. And the other thing that Irene mentioned briefly, what about bonds? How do you feel about bonds? The issue about bonds is that you lend the government or a company $1,000 in bonds, and 5 years later, 10 years later, whatever it is, you get your $1,000 back, but it buys less. It buys less all the time. That's why we're against bonds. Always.
Well, again, it depends on what you're doing in the bonds market.
Let me jump in.
You're right. Yeah, there's been some good bond plays over the years.
Of course there has.
And also you can trade bonds as well. And make
Yeah, that's what I mean.
I want to take a step back and say, I thought that I increased my cash position in August because I thought that the markets would be very jittery coming up to the election. And it turns out that I was jittery, but not the markets. The unemployment has gone down. Wages have gone up. Companies are reporting record earnings. There's no signs of the long rumored recession. And I think that the markets have been spectacular over the last few years. And so I've been pretty much, we talk about the allocation, whether it's 60-40 or what have you, but I have also practiced the sector analysis of looking at the companies that are broadly in the tech sector, but specifically in the AI, the companies that are good companies that are going to profit from the AI boom, which I believe we're just on the cusp of. And I want to finish my point. And so I owned NVIDIA, which has done spectacularly well. Taiwan Semiconductors, which I sold because I'm a little, I guess I'm jitterish. I'm a little uncomfortable with Chinese warships circling Taiwan. Marvel, which has done, it's gone up 25% this year. MRVL. These are the types of companies that I have cherry picked, and I don't mind being called a cherry picker because it's the segment of the society that I think is going to do the strongest. And the best companies that I can, based on my experience and reasoning and rationales, can identify they're going to be the best players. AMD, I forgot to mention, is also one of them. Go
okay,
ahead.
my question is, you should understand what you're investing in.
Absolutely.
So my understanding of AI is I want to take a hammer every time I'm on the phone talking to an AI robot. In the Palm Beach airport, I sat next to a guy that had multiple degrees, MBA, CFP, and he took one of my articles and he went to ChatGPT, and that AI rewrote it, and I have to confess it was better than what I wrote. And so he spoke about prompt engineering, ChatGPT, even transcribed one into poetry through ChatGPT, and he talked about clarity, specificity, context, and iterations. Now, can you just explain to me, how does NVIDIA, what are the primary stocks for people like me that just haven't taken the time to really understand that industry?
The basic thing, like Taiwan Semiconductors makes chips. NVIDIA uses those chips to provide a product that enhances the company's ability to benefit from AI. So AMD makes chips.
They're providing training for AI.
Yes.
95%.
A whole platform so that you can use it. You can plug and play with NVIDIA. And, the chips that they're announcing are supposed to be better than the ones at AMD, but AMD has still a very large market share. And these are companies that are exploiting, not only making chips now, but making chips that are designable, programmable. And so it's a new ball game that we're looking at. It's not like the old dusty companies like Intel. We used to buy a computer in the 90s and they used to say Intel inside.
That was my next question. Is Intel in this play at all?
Intel is pivoting, and
I still have 400 shares.
It got a big chunk of money from the CHIPS Act, and so it was an infusion of cash, and they are pivoting. But whether or not they can be successful against AMD, which has a bigger market share and is producing faster chips, I'm not so sure. But I took a flyer. As I say, I didn't buy a lot of Intel, but I bought a lot. So I have 100 shares just to keep an eye on it. I don't have money in the game. I won't pay attention.
I just wish, Jim, that you Californians would just knock this off and stop tinkering. I'm still trying to work out how to use Windows 95. I've almost finished learning it, and you've come out with this new stuff. But I will say, Jim, and it'll be a little bit tongue in cheek here. I think you're a bit jittery that you don't want Trump to come in here and just totally destroy the markets. And I think that is actually how a lot of people feel, not because Trump's going to be better or worse necessarily, but just because there is a factor of, what is he going to do if he wins, and what is Kamala Harris going to do if she wins? And every time there's election coming up, there is some extra volatility. But I think that there's a little bit of extra volatility this time around, as there was in 2020 and as there was in 2016 than usual. Well, hang on, somewhat, because what you don't see in the markets, you will sometimes see in the debt markets. You will sometimes see in like pushes in the euro dollar and things like that. So there is a little bit of tension there, but it's not as much as I would have expected this time round compared to previous the previous elections.
A very quick question to you.
Mhm.
Let's say you own the company. It's successful, mid-sized, maybe even large company.
Well, I'm leaving. If I own Nvidia, completely,
No, no.
I'm out of here.
It's nothing. No, nothing to do with Nvidia. Let's say you have manufacturer, or you have a fantastic bakery, or you need just any type of business, not necessarily high tech, and you need to hire CEO or president of the company. So you put an ad and the HR firms or so on. So you have a bunch of candidates. Let's say 20 people. Now you're interviewing them. Okay, here comes a person, and you're asking, okay, so what are your track record? What have you done in your life? So the guy said, well, I inherited $400 million from my father, but unfortunately I lost all of it. I had 6 bankruptcies. I had 2 impeachments. I have a bunch of lawsuits against him. And would you consider to hire such a person?
I'm not going to join you guys in bashing Trump, Sasha, but it's a really nice try. My instant reply is I'm not going to hire the person who's got no business experience and spent a life as a prosecutor. I mean, but look, I'm not going to get into politics here. I just think that when we look at markets, we looking at investments, it's important to have a look at where money flows are going. The bond market is very interesting now, Milan. Again, if you're looking at it from the perspective of let me just buy a bond and hold it, maybe that's not such a great idea. Jim, for me, I hate holding cash. Like, cash is supposed to be a temporary store of value. And so it erodes because of inflation. It erodes because of interest that you're not getting paid, things like that. If you want somewhere temporary to plant your money, you can look at a treasury inflated protected security. So that's something that pays a lower level of interest.
Yeah.
Well, yeah, but you know what I mean when I say cash.
Yeah. It's invested, but in safe and secure.
Yeah.
The rate of
but you may look at a treasury, an inflation treasury. Now that basically pays a lower rate of interest than the normal treasuries do, but it also increases the price based on inflation, and it never decreases. So if you have a deflationary cycle, it never ticks the face value down. Right. So that's a very interesting thing. It's very interesting to see, though, that oftentimes the inflation one actually underperforms the normal interest rate. So what do you look at? Well, again, the bond market doesn't trade like this. The bond market will look at, hey, how about I take the overnight interest versus the 3 months if you're looking at something like the Great Recession, the LIBOR versus the OIS in the UK went from 10 basis point spread to 350 basis points during the Great Recession. You might look at something like the 2-year versus 5-year, the 2 years 10,
well,
those
Jack,
sorts of things.
We talk about inflation, and I want to point out that there was a global inflation caused by the pandemic, the COVID pandemic, and no country has responded better than the United States has. And the inflation rate currently, we talk about the inflation like it's still high. It's really kind of close to where the Fed wants it. And so the inflation has come way down. Wages have gone up higher. Just a minute, higher. Wages have gone up higher than the inflation rate now. So, you have to say that these people are doing well. The economy is doing well. And so when we talk about inflation, yes, inflation is, but it's not like it was 9%. It's not anything like what it was following the global pandemic.
Some of the food prices, though, I just went to a French bakery that just switched from ceramic plates to cardboard, and they broke down the eggs went up like 60% or something.
But there was a chicken flu.
No. Every category of food. I mean, I think the inflation of foods.
I wasn't trying to debate.
No, I got to respond to that, Jack. Hang on. The grocery prices went up, and there's no incentive for them to lower them. What we need is competition, and the Fed has got to get out of its own way, cut interest rates so that people can start up and compete. And this is the way that you get those grocery prices down. So,
sorry. So this is
just a second. A quick reminder about our friend Adam Lamparello. He's professor of university, and he complains that he spends now more than $1,000 a month for groceries. I asked him where he's doing his shopping. He said at Kroger. Symbol Kroger is KR, Kroger. and their stock is doing spectacularly well.
Very well.
They're
Yeah, of
paying
course.
dividends,
They're making
and I
record
thank
profits.
God and
Many
thank
companies
you to
are.
people like yourself. That's where the money goes.
So
So
Whole Foods whole paycheck here.
Yeah.
No, sorry. I just want to point out that when I'm talking about inflation, I'm not talking about it as in a debate point because of the political climate of the United States.
Neither am
There
I.
is a type of instrument that you can take bets on, even if inflation was at normal rates. At the moment, 2.2% is about normal. It's been a little bit low before the pandemic. It was sitting around the sort of 1.6 to 1.8% rate across the Western world. A lot of the central banks were complaining it was a little bit too low. They were targeting 2%. You can place a bet on whether you think inflation will go up or go down. Okay, those are things that you can do. The same thing with the interest rate spreads. You can place a bet on whether or not you think the yield curve will go up or flatten. You know, that sort of stuff. So there are other options available to you. There's also the government versus corporate bonds spread, where you can take a portfolio of corporate bonds and look at the spread in yield comparative to a similar basket of government and AAA rated securities. So those are sorts of things that you can do to enhance your yield. And that's all I'm pointing out is
Yeah,
that if you need somewhere to plant your money and you're afraid that interest rates are too low, which is what Milan said, you may look at something like a Treasury inflation protected security, which adds inflation to both
Shakil,
to the
couple
yield
of
and
quick
to the
points.
face
Number one,
value.
do you remember a few years ago, Switzerland and Germany, they had negative interest rates. It was just
Japan.
a few years
Mhm.
ago, Japan as well. Now, second point what I wanted to make is regarding your suggestion, triple Q versus S&P 500. I would like to mention that the same history repeats itself. Magnificent Seven, which are part of S&P 500 and Triple Q, they are there. The case what I want to make to on Triple Q versus S&P 500 is that in S&P 500 you have Magnificent Seven and 493 garbage. Now in Triple Q you have same seven Magnificent Seven stocks and only 93% garbage. So we're getting much less garbage on Triple Q than in S&P 500. So my case is definitely for Triple Q.
A couple of things.
Yeah, but also triple Q is weighted in a way that the S&P 500 isn't.
That's right.
So there's a difference in index allocation, and that's one of the reasons too that when you look at the ETFs, the index tracking ETFs, even if you have a look at the S&P 500 index track, everyone talks about the SPY, but there are other S&P 500 ETFs, and you'll notice that whilst the differences aren't huge, it's not something that you're going to get really excited about, but you can actually do a direct comparison and see what the tracking errors are, and because of the way that they allocate. They will sometimes, you'll find one that'll outperform by 10 or 15 basis points, things like that, which is actually enough to cover the fees that you're actually paying for the ETF.
I totally agree with what Irene said. Buy what you know. And so I was tracking the NASDAQ back in the 90s, and I thought, man, if it ever hits 5,000, I'll be so happy.
Yeah.
It's over 18,000. The Dow is hitting highs at 43,000. S&P 500 is hitting highs and is approaching, it's in shouting distance of 6,000. So the main point that I want to make is the markets are doing phenomenal.
Yeah.
They have been doing phenomenal for
years. So why would you pick stocks when you can pick the market itself and not have to bother with analyzing stocks, which should be a huge job? Now, Shakil, you said you hate holding cash. It's the safest place to be in a declining market. In 1987, when the market collapsed, quite by accident, I was entirely in cash. Boy,
but how
I hate being in cash because in a declining market, there's opportunities for me to trade the market going down. There's an opportunity for me to trade the yield curve steepening. There's opportunities for me to sector rotate into other markets. There's opportunities for me to get into the FX markets because there's going to be an effect on foreign currency flows. Because I'm a lot more active, right? So I personally don't like to just be sitting there holding cash and not know what I'm going to do with that money.
As an investor, you're exceptional. Most investors lose money in the market. They're not.
Well, that might be why they lose money, Milan. Because they're not active enough.
Because they're probably doing opposite of what Shakil is doing and everything. But I did have a question about two specific fields, because I know some people that are thinking about getting in them, and I may have referred to them before and everything. But what is y'all's thoughts on investing in two major companies, and maybe y'all have the statistics in front of you, that are in the housing market, because I know some folks that have been looking at Home Depot and at Lowe's, and I know some people that have been looking at Costco's and Sam's, and I was just wondering whether those are worth those folks that I know investing in, and also the scooter companies. And I can't think of all the names of them because they got so many names. I know there are several of them, like in Canada.
People have been waiting and waiting for interest rates to go down, and I just heard on the news that mortgage interest rates in America are now down a whole 1%. So a lot of people were holding back to buy. It was almost up to 8% and now down to 6.3, I believe. So I would think Home Depot, in advance of people that have been holding back buying their first home, buying and selling another home, would be a good play.
Another reason for the Fed to cut interest rates.
I feel like I'm living in the bloody twilight zone, because prior to the Great Recession and September 11, but more so the Great Recession, when interest rates were then cut to nearly zero, everybody complained about how unfair this was to people on fixed incomes and to the older generation. That what basically low interest rates had done is that it had the effect of subsidising the banks at the expense of everybody else's savings. Interest rates finally come up after the pandemic, and everyone says this is terrible. This is a horrible thing. How dare they have interest rates at 5% when they were complaining about it being dropped to zero just 10 years or 15 years ago? And now everyone's like, well, we need interest rates to go back to zero. I don't get it. When interest rates were hitting negative yields in Europe, everyone was going, well, why the hell would you buy European debt if you've got to pay them to buy their debt? Why would you do it? Now everyone in Europe is complaining that interest rates are positive instead of negative.
No, we're talking interest rates versus inflation, and you're confusing the two. Inflation rates, we want around 2%, 3%, something like that. Interest rates, we want, to pay a little bit more than that. So, it's not a crazy.
No, I know, but it sounds funny to me that people are complaining about interest rates going from nearly zero up to 5%, 4%, that sort of range, when that's where it was prior to the Great Recession. And they had to drop it very precipitously to 50 basis points, 100 basis points, things like that.
Interest rates and inflation rates are two different things. So
I'm aware, but I'm not talking about inflation. I am talking about interest rates.
Shaquille, you cannot make everybody happy. Remember that.
No, you can't. But see, this is where it's reaching. You talked about Switzerland and Germany earlier. Now, if you have a look at what happened, I think I brought it up on one of the shows here. Have a look at what happened around 6 months ago, and admittedly, I haven't looked at it today. But we actually saw a yield spread that crushed down to the lowest levels I've seen for like 10 or 15 years. That was the Italian rates versus the German rates. Now, what's really good about those two countries, both European Union countries, both using the euros, this spread fell to 80 basis points. So could it go lower? Yeah, it could. It could go to 20, or it could go to anything, go negative. But, 80 basis points, that looks like something that I'd want to get in on, because you'd expect that to be back up around the 120, 130 mark. It's historically been over the last 10 years hitting around the sort of 160 to 200. So that looks like something that you could invest in, because it's predictable. And that's the thing. When people look at the stock market and they try to pick individual stocks, I don't think that is as easy to trade, actually, as what the interest rate market is. But because there's such a learning curve to interest rates, people just go, there's no way I'm going to do that, because I can see X, Y, Z. I can see their shop down the road. I'm going to buy their stock because I can see it.
I've got to teach you really quickly about something, and it's not political necessarily and everything, but I'm guessing, and maybe other people have heard this news story and everything, I'm guessing that we're not going to be investing anytime soon in Australian beaches, since apparently y'all have got mysterious things that are rolling up on the Australian beaches that y'all can't figure out what they are and everything, because there's like some mysterious...
Oh, this is news to me. I pay more attention to America. What's happened?
There's some golf balls that have rolled up on y'all's popular beaches in Australia and everything, and they don't know what they are, but they're thinking it's because of an oil slick or something like that. But they've rolled up on two of your popular beaches there in Australia.
Twice,
there's all sorts of things happen to you in Australia. We're just used to it. We got blue ring octopus.
On this hot topic, I'm going to have to leave the stage. I have a scheduled call.
Thank you so much, Irene.
Thank you, Irene.
Good to see you again, Irene.
Bye-bye.
Bye-bye. Marco,
you've got all sorts of things that'll kill you here, and you can't even see half of them, like the blue ring octopus. So Australians are just used to the danger.
Absolutely.
You guys have got bullets. We've got animals.
That's true.
Mark, of all the stocks that you mentioned before, stock
Yes.
number one by far is Costco. And another thing to invest, if you know some good publicly traded breeders or dogs and cats, you should buy some shares because their production will be in a big demand in the United States and certain states specifically.
Like Ohio.
You know
Did I
what
read
I've been quite
correctly?
surprised by?
Did I read correctly that Kmart shut its last store?
Yeah.
I know Kmart's been in trouble, so I'm not surprised.
Well, you can thank our good friends in the private equity space for that. You know, they go. Look,
everywhere.
I'm not against private equity per se, but some of the things that they do, like I'll tell you, as sure as I am sitting here, that if private equity realized that they could make $10 million by taking the bottle of baby formula out of the mouth of every baby in the United States, trust me, for the 10 million, there would be a whole heap of hungry babies. They just couldn't care less, and that heartlessness. But the thing is, I think the thing that's most egregious, people like Elizabeth Warren have spent a lot of time trying to tackle this, where these guys get up, they basically put no money of their own into these companies that they take over. They load the company up with extra debt. They pull all the value out and then just leave the shell. And that's not a way of. That's not the sort of Gordon Gekko, even Gordon Gekko type finance from Wall Street. It's actually worse than that. I mean, they're actually destroying companies and pulling out all of that value, and they're leaving workers behind. They're just it's a problem that needs to be addressed. It really does.
And Jim, you just have to run to Bridgehampton, New York, because apparently it is not closed yet. It'll be closing on October 20th, so that's this weekend. So I guess they're going to have all kinds of fire sales in order to get their last things. And there is one lone location, ironically, down there in Miami and everything, that will still bear the Kmart brand name on the mainland. But technically speaking, everything is
amazing.
closed. That last one on October 20th.
But I still remember Woolworths and JCPenney. So
Yeah, I'm very surprised that we haven't seen some of those major retailers in the US get an awful lot of success outside. Costco has. But you're not the Australian market is absolutely ripe for competition. You're not seeing a Walmart or a Whole Foods or anybody like that try to compete here. We've had Aldi come in from Europe, but we haven't seen any American companies. Walmart had a bit of a go in the UK. It didn't kind of work for them that much, and Walmart's actually the biggest retailer in the world last time I checked.
But
so
y'all changed names though, Shaquille. You're the one that told me yourself that what I know is Burger King. Y'all call it Hungry Jacks or something like that. So y'all get there and change the names even when
but that's because some dude had a restaurant called Burger King. And before Burger King came to Australia, and they offered him millions of dollars, he said, "No, I'm not giving you the name." So they had to call it Hungry Jacks.
Shaquille, actually, it's a great news for Australia that Aldi is coming to Australia from Europe.
But Aldi's already here. Aldi's been here for a while.
Adam Lamparella, he's doing some shopping for groceries at Aldi's. So
Aldi's here, but we've got a duopoly, and when you have a look at the upward pressure that having only two major grocery retailers has, we need to have more competition. Right. But we've got 28 million people, I think, is the population now, spread across the country, which is almost the same size as the United States. If you take away California and Alaska, Australia is basically the same size as the US in landmass. We've got a tenth of your population, and we're pretty spread out. So it's a little bit hard to compete. But I'm surprised we're not seeing more competition. Even like companies like Carrefour, which is quite big in Europe and the Middle East, we're not seeing them in the US. We're not seeing them, expand out into Asia and things like that. So I think that's
honestly, Carrefour is on the top. Their quality is fantastic.
Did Gordon Gekko good?
Question for Shaquille, since this is an investment show, because I'm looking at the most profitable industries in Australia, and I don't see any of these industries that have actually broken into America. I'm not saying they haven't, but when I see things like CSL Limited, which I don't know what that is, the National Australia Bank, ANC, and BHP, I don't know any of those that have broken into the U.S. So is there any Australian company that is actually...
Well, CSL
US.
CSL was actually one of my great love affairs from sort of 10 or 15 years ago. So I'd recently come out of a long-term relationship. The Australian market was looking a bit shaky, and I was broke as. I just, I had I think, honestly, I was down to like 100 grand, and I had like 30,000 to trade with. And I was using CFDs, which you guys don't have. And I was actually literally, in order to meet my margin requirements, having to run to the bank every day to physically withdraw cash from one account and deposit it back into the other account, because I had two separate brokerage accounts with the same bank, and you couldn't do an internal transfer. But, I made 5,000 or 6,000 every month for the first few months. And then I was able to have a couple of pretty big wins. I made sort of 200,000 or 300,000 over the space of a few months. I'm very, very aggressive trading, but I'm relatively good at it. You're highly leveraged, as I just told you, because I'm running to the bank every day trying to hit my margin calls. And playing with settlement times, you got T+2. So I'm doing I'll buy it now, and if I sell it tomorrow, I won't have to clear it until 2 days when I get paid for the other transactions. So I'm pulling all of these sorts of stunts. And then I looked at CSL and I thought, look, what am I going to do here? Because, I've decided to treat myself for a holiday to Fiji. And I thought, I've really got to do something. And we were looking at a lot of weakness in the Australian market at the time. Now, CSL, which does blood type products, was one of the very few companies that had a lot of exposure to the US market. And with the increasing strength of the US dollar, what that looked like is that they would actually have quite a good run up. So I picked up the stock at $60, held it for 6 months, and the stock went to 200. So that was a really nice return. Plus, I was levered very significantly. So that actually brought me back into a position where I could breathe again. I was back on top. I had a high 6-digit, low 7-digit, balance in my account, and I thought, okay, I'm back. Let's do this. I'll lick my wounds and mend my broken heart, and let's go.
I have the most important things to say of anybody here, and yet I am speaking less than anybody here. And the most important thing is, don't pick stocks, don't time markets, buy the U.S. economy as a whole.
And all investors picking up the stocks are losers. Most of the people are losers.
On
Don't
average,
forget that. It's a very important part of your message.
the average investor is a loser. That's true. Not many Sasha Stars out there, not many Shaquilles out there, or you, James, brilliant people. That's not most investors. So,
Milan, why don't you bring one of the losers here on the show so we could see a live loser? So we can see, okay, here's the guy, he's a loser. Oh, finally, because we don't have losers here on the show. Please bring 1, 2, 3, 5 losers.
But I do want to come back to what I was saying though before. If you do want to do something that's a little bit more than what you've said, Milan, and maybe you don't like the idea of just taking a whole heap of mutual funds and ETF, you can look at structured products. Structured products are very, very interesting. They'll give you a yield as long as, I know it can get a little bit complicated, but if you've got 10 grand, you can put into something, and you've got a $100,000, portfolio, maybe you put 30,000 aside for you to actively manage. Maybe you put 30,000 into, some ETFs, some broad-based indexes, and then you can maybe look at $40,000 worth of structured products that are going to, give you, yield and growth, and some products will be capital guaranteed, things like that, that'll give you exposure to markets that you otherwise wouldn't be able to do yourself. There's things like that. I think everybody, at the end of the day, you're responsible for your own financial future. The government is not something you should rely on. The banks aren't people that you should rely on. At the end of the day, what the decisions you make are going to affect the kind of life you're going to have. And if you don't take responsibility for it, it's on you.
Suggest something. One of my holdings in the core portfolio is Gabelli Income and Dividend Fund. It's paying monthly dividends, and it's very steady. It's growing and growing and growing, and it's run quite conservatively, but it produces fantastic records. If stock is now probably $22 a share or so on, and it pays monthly dividends of $110 per share. No, total, sorry, I misspoke.
That sounds like a buy. $20 stock, pay $100 dividend. I love it.
It's only for a week, though.
Yeah, so if it pays every month, And so you collect what, 12,000, sorry, 1,200 a year. So what yield is that? If the stock is 22 and you're collecting every year at least $1,200, that's not such a bad yield. And the stock still appreciates in price. So you might look into that. It's not, I think it beats S&P 500.
When I also,
but as Milan says, you have to be active in the market, right?
To say Milan, to emphasize for what Milan is telling us, you know, I always have a certain amount of my money in a broad index fund, and you know, I just don't have to worry about it.
Yeah, exactly.
You know, and but when I'm interested in something and I'm tracking it, that's when I'm involved in buying and selling stocks.
If you
And
enjoy
it's fun for me. So this is the difference. So if you don't want to watch it, Milan's strategy is just perfect. You know, broad-based index fund, you can do that, and I don't have to worry about it. But if you do want to worry, like I do,
just really quickly along those same lines, what is our thoughts? Because there's another company that I was mentioning. I was actually chatting with Shaquille about it, and he said I could mention everything. But what are our thoughts about investing in companies like Aristocrat? Because apparently Aristocrat there in Australia is a gambling machine company and everything. So
that's the world's largest, and Vegas is really interesting because you would think that Vegas would absolutely be, you know, the top of this, but no, it's a little Australian company, but it's not little, that you know managed to get the slots, and we call them pokies, you guys call them slots over there. Very, very interesting scenario for Vegas. You've seen a couple of other companies like Kanika, for example. I think Kanika should have done quite well. Their share price got very, very heavily depressed. But part of the reason for that was because the Vegas casinos cancelled massive orders because some of them had some financial problems. So Aristocrat is the world's largest provider of these sorts of gaming machines. One of the companies I think's had, like CSL, has had a lot of success because of the United States. And I think that they're the most dominant player in this space. So there is very, very few competitors and a lot of hurdles in order to be able to compete with them in the first place. So that's a strong company.
yeah.
BHP that you talked about before is actually Australia's largest company. It's a mining company. But you can buy them in the US through an ADR, and they're also dual listed, I believe, in the US.
I would also recommend one idea for people who want to park their money and don't have anything better to do with it. It's a Canadian company, CNQ. It's a Canadian Natural Resources. It's pay about 4.5% dividend. Should I say, very saved stock. I'm not recommending that you cannot lose any money on it. Everything is possible,
Right.
but that's where I would park the money. But I don't have any money to park. It's everything parked in NVIDIA and ETFs, high yield producing stuff, and so on.
I will say to one of the comments that Milan made earlier about declining markets, very interestingly, when markets are declining, you generally don't want to be in things that involve discretionary spending, with one very glaring exception, which is the sin stocks. So you're talking alcohol, tobacco, gambling stocks. I don't know why gambling stocks go up, but they do. People tend to gamble more when they've got no money. The logic of people. And there is a company that I've only recently had this on my radar. Apparently in Vegas, there is the world's biggest strip club. And the parent company that owns this is a listed company. And every time the market turns down, their stock price seems to go up. And I don't get it. I honestly, remember I said the other day, I'm a complete moron. I don't understand the markets. But all the SIM stocks just seem to do very, very well in a declining market.
that's one of the things I was going to ask Jim.
But you look at yield, and I'm certainly not promoting smoking. But if you look at yield, you know, the tobacco companies are very similar these days to the utility companies. The stock prices are fairly steady, and the yields are fairly reasonable and pretty consistent. You know, you talk about, you know, companies like Philip Morris, etc. You know, British American Tobacco, all of those sorts of companies. The big Japanese one, I forget their name at the top of my head. they all seem to do pretty well under most market conditions. So
I have those in my core portfolio, and I don't regret of any, because not only is it they keep paying dividends, 9.5%, 8.5%, the share price is going higher as well. That's incredible. I don't take out dividends, but they're accumulating on my account, and then I'm taking like once every 6 months. I'm taking out some dividends.
So Milan, I wanted to ask. Go ahead, Milan.
Shakil, you said something very important earlier, and that is you said, know yourself. You are the world's leading expert on Shakil. And know thyself is really important.
Nobody knows Shakil better than Shakil himself.
Well, my mother would beg to differ, but I do want to. I think that is a very important point, because when I first started out, I used to hear a lot of things, and one of the things that people used to say to me all the time was, you know, Shakil, what you've got to do is you've got to have a plan, and you've got to be disciplined, and you've got to be organized, right? And most people would say, yeah, that sounds really great. No, it doesn't. It sounds terrible, because anybody who knows me knows that being disciplined is the last thing I am. So if somebody tries to give me a strategy for trading the markets, which requires me to be disciplined and stay to a plan, it's going to fail abysmally, because I'm not disciplined. So there's no point me trying to come up with strategies that require me to be disciplined. I would rather have the huge volatility. That's why I buy options a lot, because I'm quite happy to take those risks. Because when I do have a win, it's a mega win. I'm popping champagne and eating caviar. When I'm not, I'm moping around the house and go, I'm not making enough this week, right? That's what I like to be. That's how I like to be. Now, heaven help any woman that's with me, because I'm just this emotional roller coaster most of the time. But that's who I am. That's just my personality and my nature. Now, and other people don't want that.
We don't want to leave people with the false impression that you don't just buy the S&P and hold it and watch it and forget about it. You're selling calls, and you're trading in options on the S&P quite actively, at least once a week. And sometimes you were telling me even the same day. Isn't that true? Am I being fair?
Milan, would you like to respond?
What I do every day is
every day.
On a daily basis, I write covered calls. First thing in the morning when the market opens, I write covered calls. Expiry date, the same day. First thing in the morning, you write your covered calls, expiry date, the same day, and you get unbelievable returns.
Milan, on a day like yesterday, I don't think that it would be a very profitable strategy, because whatever you made on covered calls, you would lose way much more on the S&P itself.
Sasha, that's true, but you know that the S&P will recover. The American market is going to get better off today better off 10 years from now than it is today. 5 years.
Popping champagne more often than he is moping.
Well, yeah, and I was just saying there, if you are a more disciplined person, then you look for those strategies. Milan, zero DTE option strategies seem to be all the rage amongst especially the young people, and heaps of volatility and all this sort of stuff. Right. Look, horses for courses, if you like that, great. I would almost suggest you may as well go to a casino, because at least then when you lose your money, you get a free room and a $2 buffet. But if you insist on gambling in the market, zero DTE is where to go.
And in casino, you will have free drinks and sometimes dinners too.
Yeah, that's right.
Guys, with that, we have to conclude our lovely show today. I thank you very, very much, everybody, for participating. And good luck in your trading, and see you next Wednesday, same place, same time. Good luck. Bye-bye, everybody.
Yeah.
Just talking about Vegas. I was still on. Sorry.
Are we off the air now?
Not yet.
Keep going.